Hey everyone, hopefully you're having a good day. Again, my name's Andy. My channel is Finding Value. And I'm going to go through uranium. This is a lot of uranium stuff here. I'm going to go over a lot of information. I know there's a lot of people that are very excited. First, calm down. It's the weekend. We've got a long weekend. We're not trading Monday. So we'll be trading Tuesday. And what I have behind me, and I'll zoom in on and look at all these charts and stuff. This is a little bit more information about the companies. And I think I got most of this right. Some of them, it's kind of hard to find what their total pounds is for measured, indicated, and inferred. But what I'm doing is I'm looking at valuations. I'm looking at some of the projects that some of these guys have, how big they are, how small they are, how many pounds they have in the ground, what are you paying for a dollars per pound basis. This is a little bit old, but overall, it's very close. Even though that we've had a big run up, everything's kind of run up at the same amount roughly. I'm going to go over the Lassonde curve. I'm going to go over some other things here. So first, I'm gonna scroll down. I'm going to kind of show you what the Lassonde curve looks like, and you're going to lose me here very shortly. Well, I might be able to stay in here. So this is the Lassonde curve here, and what this is it's the life cycle of a mineral discovery, and this is where value gets added to the share price, to shareholders. And this is very important, I think, to understand. The majority of my investments fall in two areas of the Lassonde curve. The Lassonde curve, it looks like this. It ramps up where the share prices would go up. It comes back down because enthusiasm goes down, and then we ramp up again. Where we want to be looking at investments, at least where I look for investments, I should say, is I look for in here and at the bottom here. And what this is junior exploration companies are in this area here. They're actively looking for deposits in the ground, and when they hit something big, it adds a lot of value to the shareholders. So I do have a smaller portion of my junior exploration companies, a smaller portion of my portfolio in those types of companies. And I spread it amongst basically all of them that have potentially good finds. And most of them are in the Athabasca region. And I think I own all of those that I think could be potentially big hits. Another one, so that I'll just read this real quick. Digging in, junior exploration companies are typically the first on the ground, proving a geology concept with surface exploration. And that's some of the ones that I'm in. Then the speculation hits. Initial drill results provide some insight as to what truly lays beneath, but more work is necessary to define a mineable deposit. Early speculators buy into the project. That's when things really start to take off. And then they have a discovery. There's a tipping point in exploration when drilling amounts to a real mineral discovery and excitement is at its peak. And that's when you want to kind of ditch out of it. It's at this peak. Then it goes into an orphan period. It's after the initial excitement. Proven discoveries require large amounts of capital for construction, but we are not yet receiving cash flows from an operating mine. That's why it goes down. All that excitement wears off. And remember, what moves stocks? Money flows move stocks. People with money flows. Money flowing in, money flowing out. And that hinges on excitement and people. When you get to the bottom portion, this is where we have all those developing companies. They have deposits, but they have to develop a mine from it. So the initial strategic investment, this is a point where experienced mine developers and financiers invest directly to develop the project into an operating mine. And then when we're getting closer and closer to the operating mine, it goes up. And then if your uranium price is flat, usually what happens is it goes down because you have max value at the beginning of a production of a mine, because all of the value is still in the ground and the mine is built and it's ready to go. And you got readjusted upward from a developer and the pounds in the ground to a producer pounds in the ground. That's the value added. Then when you start producing, you're actually basically taking the value out of the ground and selling it. You're realizing that value. And so over time, your value should be going down a little bit because you're depleting the resource. So what I try to do is I focus my investments at the development stage, the beginning of a development, which almost all these uranium companies are at the beginning of development type companies, because they didn't want to progress it forward because they couldn't get the money to do it. And two, we were below the cost curve in terms of uranium price. So we're all at like the sweet spot for a lot of these companies that are developers. The producers, I don't go too much in them. You can go in it because uranium price going up is going to reprice those guys higher. But I'm swinging for the fence. So this is my speculative money, and my choice is to swing for the fences. So I overweight some of these guys in the development stage because I know they have a deposit. They just have to develop the mine. I underweight or have smaller weightings in the junior exploration companies because there's far more risk. They may not find something. And if they don't find something, they may not be repriced as high as some of the developers, because the developers, we know they have the uranium. They just have to develop a mine out of it. There's operational risk there. But the good portion is that we know they have pounds. And if uranium goes way up, those pounds are going to get revalued. This next to it, go underneath here. So over here, I've got another chart. I grabbed this from UEX's presentation here. And what this is you can see the market capitalization per pound of U3O8 of combined resources, publicly listed uranium developers. And this is UEX down here. They're very cheap. Post JCU, they're at 0.91. We've got Goviax, Anfield, Azarga, Encore Energy, Global Atomic, Fission, NextGen, Denison Mines. And what you're looking at is you're looking at developers right here. This is the Athabasca developers, and this is the producers up top. So the producers, you're paying a lot more market cap per pound in the ground than you are with the developers. And when you develop, when the prices go up and these global developers start to become producers, these valuations of market cap per pound in the ground is going to get revalued up to a producer when they hit a producer status. So that's value to the shareholder. So this is where your gains come from, going from an explorer to a developer to a producer. They're adding value as that progression goes. And when the uranium price goes up, these are going to all get revalued higher from a twofold revaluation. And you're going to say, a twofold revaluation, what do you mean by that? So the twofold revaluation is you're going to get the value from the uranium itself, and then you're going to get the value from them going and progressing from a developer to a producer. That's a twofold gain. And as a high-cost producer, I'm going to talk a little bit about high-cost producers a little bit. High-cost producers are, obviously, they're high in cost. So people, when the price is below the cost curve, when they're below the high-cost producers, people are going to price them at a very low level, basically pricing them as they're never going to go into production. The sentiment towards those high-cost producers is worse at market bottoms than what it is, obviously, at market tops, or when the price of uranium goes up past their cost curve break-even point. So what I like to do, and this is not recommendation, I like to go into some of these high-cost producers that have very, very low valuations, because I am a huge bull on uranium. I think uranium is going to go far higher. So when uranium passes the break-even point of some of these companies, the valuation sentiment towards those companies can change rapidly. And they could go from a very, very undervalued state to a very overvalued state because of the enthusiasm around it and the momentum that it would have. So usually what happens over the progress of a commodity bull market is that at the bottoms, the high-cost producers get basically flushed out. Nobody wants them. Everyone's going to tell you it's a high-cost producer, it's a project that's not very good, and nobody wants it. Now, there is risk that the project could be bad. But if the project's good and they have a good CEO and they have a good technical team that could, pull this thing off, when the prices start to change, just because they're a high-cost producer doesn't mean it's a bad company. If they have a good technical team and they are able to, basically turn this project into a successful project, and the price goes way past their break-even point, and I'm just going to make up a number. What if their break-even point is $60 a pound, and we go to $300 a pound? And I know that seems crazy. And let's say they can actually pull it off. You're going to get the undervaluation when no one's looking at this stuff to the downside, when you bought it pennies on the dollar. And it's going to get revalued way up there because everyone and their market sentiment is saying, sell that company, sell that company. So what I'm telling some of your positions should be a contrarian pick within the contrarians. That's where that's where my bread and butter is. It's buy the companies that are high cost producers that nobody wants at market bottoms, because those will be the ones, if you look at their earnings per share price, that's what moves companies. You go from a negative sentiment and a negative, they don't make anything, to a exorbitant amount over a long period of time. It's going to take some time to develop these minds and whatnot. Over to an exorbitant amount, and your multiples over the beginning earnings per share. It's your earnings per share that you're worrying about as an investor. It's not the cash flow. I mean, cash flows are important, don't get me wrong. But what makes the shareholder money is your earnings per share growth. And a high cost producer has nothing today. And if the sentiment is ultra negative against them, it pushes them even lower. So your best buys at market bottoms, so long they don't go bankrupt, are the ones that everyone hates the most. Then it gets revalued when the price goes above their break-even costs. And if it goes way above their break-even costs, their earnings per share will give you the largest leverage and multiples during the bull market. That's if they're successful. Sometimes you don't even need to be successful, and it's like that. So some of these I invest in, I'm taking that approach. Doesn't mean that approach will necessarily pay out. That's why I diversify and reduce my risk by through diversification and through my position sizing. My position sizing is between 1% and 5%. And I may overweight some of these that are higher risk, high cost producers. Now let's go up here. I'm gonna come up here. This is another one. This is from a different presentation of Goviax. Goviax is very cheap. We've got other producers here. This is the developer average of $1.86. This is another. Here's Goviax, other, Africa, Australia, USA for the developers. Then you go into producers, and they're priced quite a bit higher. Notice, let's say it's $2 here, $6 here. You're going to get revalued a 3x going from a developer to a producer. That's the value to the shareholder right here. Now, if you've got an increasing uranium price, that's going to go up as well. So you've got you're moving it all up, and you're adding value as you go from right to left, from explorer, developer to producer. Here we've got the global peer comparison reference table I have in the background here. I'm going to take myself out. I'm just going to show you a little bit of some of these companies. Here we go. Let me zoom in again. Let's go a little bit more. Okay, there we go. So here's some of the companies on the left-hand side. These are the projects that they have. And this is their resource in measure, indicated, inferred. I kind of prefer the bigger companies that have a little bit more resources, because if someone's going to do a contract, you want to go to one-stop shop. And I think some of the bigger ones, I think, should be valued a little bit more. I like Bannerman at 270 million pounds. That's one I like a lot. I like Goviax. That's got kind of a 140 million pounds is what I've got for resource measure, indicated, inferred. This is from the Boss presentation. Fission's pretty good, and NextGen's good. I don't know what ACAP Resources is, but that one looks all right. And then some of these smaller ones, I do have money in it. Goviax, again, here's another one, Mutango 160. So Goviax has some good pounds. Bannerman has some good pounds. Denison Mines looks like it has some good pounds there. Forces Metals has some good pounds. And those are the ones that I've really focused on, were those ones there. And some of them are high-cost producers. So that's kind of what I look for as well. So I'm gonna go up here. I've got some more stuff. So what this is, to zoom out just a teeny bit. This is the CapEx and all-in costs for some of the projects here. And they have the projects here. I'm looking at some of these bigger circles. So what this is, it's pre-production CapEx. The bigger projects are going to require more CapEx to get it going. And some people think that that's bad because of what they're going to say is, well, how are they going to get the CapEx to fund the mine? And my opinion is they're going to get it in a big bull market when people need it. So I'm taking the opposite bet, and I'm saying, well, Etango, which is the project of Bannerman, is kind of a higher cost producer and needs more CapEx, and I think they're pricing it pretty low. So I'm taking that bet of Etango and their project and buying into some Bannerman. Here's another one, Arrow. Arrow is Next Gen Energies, and this is Fission's project here. So these are other ones that I also like. They're very low in cost, but they're high in CapEx. Griffin is Denison Mines. Phoenix is Denison Mines. So Denison Mines have some smaller ones, but they're pretty low in cost. And the CapEx isn't too bad. So that's also good. Goviax is this big circle here. It's Medulia, and they also have Mutanga. Those two, I think, are pretty good. A little bit of a mid-cost type producer, but I like those two quite a bit. In here, Lance, I think, is Peninsula Energy. Honeymoon is Boss Energy. And these are some American ones, Dewey Burdick and Lost Creek. I can't remember. UR Energy, I think, is one of them. So that's that there. So I like Etango, I like Arrow, and I like Goviax's are the ones that I kind of like. And Denison Mines look pretty good as well. Now, looking at what I have is I have the name, the ticker symbol, and the market cap with their pounds in the ground and the dollars per pound. And I did this per company. And I know it's going to be a little bit different. I didn't update it recently, but I think the relationship is still there because they all went up roughly the same. So the ones that are cheap are still cheap, and the ones that are expensive are still expensive, is what I'm saying. The ones that I really like are in red. I like Next Gen Energy quite a bit. I like Global Atomic. I like Fission. I like Encore Energy. I like Deep Yellow. UEX CF is pretty good. Forces Metals. I like Bannerman. Bannerman's a very cheap one there. I like Goviax. Goviax is very good, I think, in terms of dollars per pound and the potential from a developer to a producer. And then I also like all of these guys down here with the exploration companies. The exploration companies that I like are Sky Harbor. I like Canalaska, PurePoint, Asian Court I have a little bit in, Standard Uranium, Baseload, Fission 3.0. I do have a little bit in ALXEF, very small amount. So those are some of the ones that I own. Some of these other ones I don't know as much about, like Vimy I don't know as much about. I own a little bit of Laramide here. Forces Metals I like. These are some pretty good valuations through here. Encore Energy. ISO Energy, they have a find. This is an exploration company that is defining that find. Some of these ones up here I'm not as interested in for myself, but they might still do very well company-wise. So that's what I like. Those are some of the companies that I prefer. Again, I'm swinging for the fences. I'm not into the producer camp as much. You're paying a little bit higher premium. I don't think you're going to get that revaluation for all the pounds in the ground. There's more risk where I'm at. So it's not a free, it's not one or the other. There is risk where I'm at. So I'm trying to balance all that stuff and diversify out a little bit. I am swinging for the fences for some of these picks. Bannerman, when I was buying, was $0.19 per pound. It was so cheap when I was originally buying it. Now it's 51 cents, and it's probably gone up another 20% or so from, the last week or two. 20, 30%. So those are the ones that I like. Take it for what it is. It's just my opinion. It's not advice. You guys at least know kind of where the companies are at, how they get priced, where the value's at in terms of exploration, developer, and producer, and progressing through that and adding value to the shareholders. You know about the Lassonde Curve and where I'm invested in exploration and developers mainly, and a little bit of the dollars per pound that are behind me. And those dollars per pound I take it into consideration, but it doesn't necessarily mean that they are the ones that are going to perform the best in this bull market. I do think that some of these developers, there's going to be something somewhere that's going to be a huge winner. One who progresses from a developer to a producer and is cheaply priced and is going to get revalued much greater. So if you guys like this content, give me a thumbs up. I appreciate you guys listening. Subscribe to the channel if you haven't already. Thank you. This is Finding Value.